Hey everyone, in today's video, I'm going to be talking about 8 stocks that I already own that I'm interested in buying more of potentially. It should be a good video. I'll timestamp it at the bottom so you guys can run through it if you just want to look at a couple of the names, but really looking forward to this one. So, the first stock that I'm going to be talking about and going into a bit more details about their recent performance is A&W Royalty Income Fund. So, I've talked about this one before. It was a position, just for background, that I was aggressively adding to throughout the year here. I'll give you the 1 year chart. As it kind of didn't really move in the broader market, trended up for the most part. I was adding to this one, built it into an $18,000 position. I got it to the point that this stock actually pays me about $1,000, just over $1,000 a year in this account. I'm considering adding more to it at these prices. We're trading at 34, 35 dollars a share. The company's paying out over a 5% dividend yield here. And if I just compare it to like a different style restaurant company, whether that's McDonald's, Yum Brands, Restaurant Brands International, the stock is trading for like 16 to 17 times earnings. They've continued to grow their top line revenue, which is all that really matters for a royalty fund. And while they're not globally diversified, they're solely operate in Canada here. But they do have a lot of they do they do get around lots of risks and issues that some other companies in the restaurant space have. Whether that was like exposure to Russia, exposure to Ukraine, exposure to China, and the uncertainties in that market. So diversification has benefits, but it also has cons. And this is a company that plays in a pretty safe and developed market. So I like the fact that it hasn't been bid up a lot. I get a nice monthly dividend yield. It's pretty safe. Looking at the recent performance of the company here, the income actually increased from the royalty fund about 5% last quarter, 6% year to date. So going back to the stock, in the last year, the royalty fund, units of this royalty fund are down 10%, but they continue to grow revenues pretty nicely here, which is a good sign in terms of the fundamentals of the business. So I just think this one's fairly valued. Some of the other restaurant stocks, maybe even overvalued. So relative to them, I think it's a good deal. And it's one that hasn't really got bid up too much. So I'm kind of holding on a bit now, just because I've just been pummeling this position with more and more shares up to $18,000. But this is one that if it stays down here, I'd be more than willing to add more of it to my portfolio. Going into the second stock that I'm looking to add more to my portfolio is Diversified Royalty Corp. So in this account, I have about $6,000. Across my accounts, I do not have a ton of Diversified Royalty Corp, but it has been paying me a really stable dividend yield, about 8%. They've actually increased the dividend twice since I started holding it. And you can see that the stock price has been going all over the place a bit. You know, about half of their revenues, as I look at, I'm trying to find the right one here. Having a hard time. Okay, I'm going to, here it is here. Sorry about that. Half of their revenues, a bit less than half, come from Mr. Lube. And as we've seen other car companies start to state, getting a car takes a long time. Getting a car is increasingly more expensive, and consumers are pulling back a bit in some areas of the economy. And more people are trying to fix cars and stuff like that. So I think they will just naturally benefit from their ownership of the Mr. Lube trademark. I think that's probably long-term a growth business for them. I do like some of these other businesses they're operating in. Stratus was a new acquisition they acquired from the US. It's in a bit of a dicey spot in terms of commercial cleaning services, probably some office exposure and stuff like that in there, but they got a pretty good valuation on it, which I like. And I just like how diversified it is. No pun intended, given the name of the company. But, you get some real estate brokerage exposure. Air Miles is a loyalty program. Mr. Mike's is a restaurant. Oxford Learning Centers is an education. Nurse Next Door is like an old age play. Stratus is commercial cleaning services. And then Mr. Lube is like car repair. So you're all over the place getting incomes from all types of streams, and the valuation is right on it. 8% dividend yield. They've even had some growth over the last little while. Long term, the stocks have held up just fine. Even if the stock's down slightly, the price to earnings compression has occurred here for some reason. Well, maybe interest rates partially, but getting an 8% dividend yield a year still makes the total return on this stock pretty decent over the longer period of time. So it's one that I think I like the immediate cash flow nature of the company and the asset light business model. I like that I'll be getting a monthly dividend or higher monthly dividend. So this is one that, I'd love to get it back in the 280s at least, maybe around 280. So if it dips a bit, it's one that I will have on my radar to add in my Wealthsimple portfolio. So the third stock, and you may have got a sneak peek as I missed the right tab there, but it is Riocan. This one's a bit more of a contentious one. They do play in the retail real estate market. They're going to do about $1.80 in funds from operation this year, so they're trading at about 11 times earnings here. I think that's a very reasonable, if not undervalued, valuation. You look at companies in the U.S. That are in this space, they trade mid-teens, 16, 17 times earnings. Riocan even is more defensive than lots of those companies in terms of their tenant mix. Canada as well is a much less developed retail country than the US. Like retail feet per square foot, dramatically less in Canada. So you'd think as retail kind of corrects in size, let's call it over time with e-commerce and stuff, the current players won't be hurt to the same extent as they may be in the US, depending on the type of assets they have. Riocan also has the majority of their assets in big cities. So looking at just how that comes to life in a couple of visuals, you can see here a large percentage of their rent actually comes from very defensive sectors of the market. They do have a couple maybe more risky elements of exposure, 6% apparel, 7-8% furniture and home, but I don't think these areas are going to zero. Like department stores could go to zero, but that's 1,000th of the business. Personal services, that's like hairdressers, dentists, doctors, stuff like that, 8%, that's probably good. Experiential post-COVID has been really strong, and then all of these up here have been doing really well. So the vast majority of the payroll or rent slip rather is in a really good position. Investment grade tenants, some of the biggest companies in Canada, paying you rent every single month. The other component that they have here, if you look at what builds their business, is they've been building out a residential rental component of their business. It's still very small. I think it's about 3 or 4% of their total fund from operation. They have aspirations to get that closer, I think, to 7, 8, 9% to be a bit of a safety net in terms of their monthly rent in tumultuous times for the retail side. But the multiples in the residential rent space are closer to 20, 21, 22. If you look at companies like Cap REIT and stuff like that. So you also have a little nugget of value that is in this 11 times funds from operation multiple that should potentially be increasing and expanding that multiple over time. Okay, the next stock is actually a stock I do not own in this portfolio, but it is Disney. And Disney's a stock that I've owned it for a long time. I probably started buying Disney around $100, probably even longer than 5 years ago, it looks like, by looking at this chart. And my average buy price on Disney is about $120, I think. So I am down all time on Disney, about 30%, give or take. And on Disney, I've been debating just buying some more shares and just pretty much taking a flyer on the company, having some blind faith that they can, figure it out. I haven't been buying the shares over the last few years. Once it ran up past 150, I kind of thought it was getting in an aggressive territory. Went all the way up to 200, but also haven't really bought on the way down either. Currently $156 billion market cap. I used to think that Disney had a path to getting to $10 per share of EPS, which would make the current price at about 8.5 times earnings. As we look at their business, right now, you can kind of just get a sense for how dire the linear business is doing. They lost revenues of 6%, 7% in the last quarter, and that's, huge business, biggest part of their revenue. So that's alarming in itself. But what's even more alarming is the operating income coming from linear networks down over 30%, which accelerated from 29% over the past 6 months. So this is a huge drag on the company. They really, really need this revenue as they continue to develop their D2C business and try to make that profitable over the next few years. So I'm just having a hard time building back to that $10 in EPS that I used to have line of sight to a number of years ago. And, we'll see how it all nets out. But this is in entertainment. They have tons of great iconic assets. They historically have been really good at managing their business. Aside from Netflix, who has like all the tailwinds at their back, I think Disney, just from a history of execution, brand standpoint, the assets they own, the theme parks they have, are just really well positioned or best positioned to figure out a way to get out of this. And if they do, I think that we'll go back to see that $85 a share was a great buying entry point for the company. So I'm monitoring it a bit more. I want to see what earnings they put up in the next quarter. But this is one that I've been debating just taking a bit of a flyer on. Going into stock number, I think we're going into stock number 5 here. It is Realty Income. So Realty Income is a stock I own in this portfolio. So I'll go over to it. It's one that I've recently been acquiring over the last number of months. I currently have about 140 shares on 9,000 US dollars. But recently it's ran up about 6%, give or take, not behind too much other than consensus feel that the Fed may be done raising interest rates. Just a story I've heard half a dozen times over the last 18 months. So I'm not really buying into it. We'll see how it goes. I do like how it's still down from the highs. But at the end of the day, this is a really strong REIT. They pay almost 5% dividend yield. I'm just going to go through a couple aspects of their business here. They are the 4th largest REIT in the world. So I think there's some safety in large numbers, super diversified in every single state in the country. And they also have started acquiring assets in Europe, which as a Canadian investor, I don't really get that much exposure outside of North America. So I like that element of their business too. The bottom right-hand side here, you can see they've increased their dividend for 30 straight years almost with a 4.5% CAGR. So I get a good starting yield at about 5%, but I also get some dividend growth, which is great to see as well. And I kind of like how they flex on their monthly dividend reports that this is their 637th consecutive dividend. So every month that number goes up, and it just shows how proud they are of paying their dividend, not cutting their dividend, increasing the dividend year over year. And I think they'll continue to do that into the future. Now they have a bit of a better visual here than Riocan had, but similar story where I feel really comfortable investing in properties with tenants of this nature. I don't see a mix or a situation that all of these tenants may receive pressure at once. If it's a recession or economic downstream, like Dollar General, some of these other companies should do fine. Some other ones may struggle, but generally, I think they have a really good asset mix. They can move quick and address shifts in the economy and shifts in their tenant portfolio if needed. In the top right-hand corner here, you can see the majority of their businesses in these very defensive places that you'd want to own real estate to support these businesses, because they're pretty reliable industries, reliable businesses, make lots of money from a profitability standpoint to pay their rent. And then they are super well diversified across the US. So I don't have a ton of US exposure. I actually have almost none from a real estate perspective. So I thought this was a great stock to add. And it's one that I wouldn't mind building out closer to, 200 shares if the price is right. It gets back under $60. They have a good earnings report relative to the price they're trading at. So this is the 5th stock, I believe, one, two, three, four, fifth stock that I am considering buying, which I already own. Going into the sixth stock here, the sixth stock back on the Canadian side is Fortis. So this is a regulated utility company. You can kind of see it here, have about $10,000 in it. They pay almost a 4% starting yield. But as you'll see on their investor page here, they have committed to increase the dividend 4 to 6% a year to 2027. So since I've actually held this stock probably 6-7 years ago, they have consistently had very similar guidance over a 5-year period. So they said they were going to increase the dividend 4 to 6% a year from like 2017 to 2022. And I'm pretty sure they literally increased it 6% every single year since I've owned this stock. So they take this very seriously. They have a business model in place where lots of the work they're doing are in regulated utilities. So they know exactly how much money they're going to be getting for the projects. They know what their return on invested capital is going to be, assuming they don't overspend their budgets. And when they do that math and calculate the accretiveness of these investments, they're able to forecast the efficiency on a profitability per share basis and include that in the dividend. So we have a big year coming up. We're about to hit our 50th consecutive dividend increase. So on this stock in general, I just think it's a boring stock, but it's paying me for 1% every quarter just to own it. And it's also forecasting short, medium, long-term reasonable dividend growth on top of the 4%. So I like it as a safe income play, not the sexiest stock I own, not going to double anytime soon, but I feel safe at night owning this stock. Okay, going into the next stock here, which I'm just going to check, maybe my last stock. Oh no, I have one more stock I'm going to get to before my next one. A bit disorganized today, but my next stock here is Bank of Nova Scotia. So Bank of Nova Scotia is down over the last year, down over the last 5 years as well. They pay a 6.3% dividend yield here. So really strong payout. You get over 1.5% back each quarter you hold the stock. And this is a stock that's been around for like 100 years or something like that, has increased their dividend almost every year in the last 50. And when you look at the long-term chart, I wish I have a Google chart here, so we'll take a look at it. But when you look at the long-term charts, this company has consistently been a strong buy whenever it's in dip. So you see here was a dip in the 08 recession, blew back, dip during COVID, obviously blew back, had a dip in 2016, blew back as well. So I think this is, just looking at the chart, I'm not really a chart guy, but looking at the chart, also just the fundamentals of the bank, their history of being able to deliver return on invested capital and capital appreciation over the long term for investors. I think this is a great time to boost my position in Bank of Nova Scotia. They're still super profitable. They're trading at like 8 times future earnings. They do have a bit of a Latin America business, so I am getting some geographical exposure as well. So that is the 7th stock that I am considering adding to with stocks that I already own. And that gets me to the last stock for this video. So the last stock, I'm going to have to go back to my US account, hopping around a bit. And this is actually a stock that I was super interested in building a bigger position in at the beginning of the year. Now, unfortunately, the stocks jumped up about 20%, 15 to 20% since then. But I think Visa is an absolutely amazing business model. Looking at their business a bit here, I think they're trading close to 30 times earnings, pay a very small dividend, but they increase it about 20% a year, 0.7% though, so that shouldn't be a big element of your investment hypothesis, let's call it. Just looking at their recent earnings they reported this week, they had 12% top line revenue, 20% GAAP net income growth. Non-GAAP earnings were a bit lighter, so only 7%. So there may be some accounting dynamics there that are worth looking at. But even non-GAAP EPS, let's take that number of $2.16, went up 9%. So despite FX and lots of other headwinds, they're pretty much growing their earnings 10% a year over last year, which was explosive growth for them, which is great to see. In addition to that, this is one of the most productive companies I've seen. They have like net margins close to 50%. They spend almost no capex. Like, to have a quarter that you make $6 billion in cash flow and you spend under 300 million, you're pretty much spending 5% of income, not revenue, 5% of income on capex. So just tons of money. Out of the 5.8, 5.5 flows to free cash flow. With that 5.5, they bought $3 billion of shares, paid out $1 billion in dividends, which leaves about $1.5 billion that they bolstered their balance sheet with. So just an absolute fortress of a cash flow machine here. And they really do provide shareholders a lot of value back by buying back shares and increasing the dividend, even though the dividend's small for the size company. But I just want to take a look and share like what they've done in terms of share buybacks and the value that's created for shareholders. As we look at this one long term, you can see they've pretty much halved their share count over the last, let's call it 13 years. And you can see every single year they've bought back a number of their shares. They had some extreme years there. So let's just go over the last 10, 2.5, 2.5, 2.5, 2.5, 2.5. So they approximately buy back anywhere between 2 and 2.5% of their company a year, which is a huge return. That's the same as having a 2.5% dividend paid out, except it's actually better for a company that's been able to increase their overall value because they're buying it back at lower prices. So as we look at the stock over time, all these stocks that they were buying for you at 2.5 or 2.5% increases to your position every year through share buybacks, that value of that investment on your behalf has gone up 150% in the last 5-6 years. So it ended up working really well as a compound accelerator for Visa's business in terms of their core business fundamentals. And I think that as long as regulation doesn't get in their way, this company is going to continue benefiting from cash to card transactions, continue benefiting from more traveling and larger transactions. Inflation, if anything, helps this company because they're essentially getting a royalty on the top line of the entire global economy. So really love this business. I think their funds from, or their EPS estimates for next year, closer to $10, give or take, depending on what analyst you're looking at. So even though they're trading probably at around a 30 times this year, I think that should go down to closer to about a 26 to 27 times next year, and then about a 24 times the year after. So I think they have just a really long growth path on this stock, and I'm looking forward to that starting EPS multiple I'm paying to compress over time as they just compound their earnings, compound their top line like they've done over the long term. So there you have it. Those are the 8 stocks that I am currently evaluating adding in my stock portfolio. Let me know what you think about these stocks or what stocks you're looking at in your stock portfolio. If you wouldn't mind hitting the like button, it really does help me for the YouTube algorithm for small channels like myself. And if you like this type of content or you want to see more content like this, be sure to subscribe to the channel. I recently did a full portfolio review of my Wealthsimple portfolio that I'm kind of scrolling through here. So if you want to see that, be sure to click the link I'll put in the description of this video as well. And I will see you guys in the next one. Thanks.